How are you guys? This is Isaac Salcido. I'm very excited to be here with you guys today. So the video of today is the 3 areas where you can put your money in, okay? It's gonna be the pros and the cons. This is a continuation of the previous video where we talk about taxes. Have fun, guys, and let's jump in. How are you guys? So let's jump into the different categories of where we can put our money actually. So there's only 3. Tax now, tax deferred, and tax advantage. And from these 3 different categories, where do you think we should put our money in, right? What's the best place to put in our money? Tax now and tax deferred. Most of us only know these 2 type of brackets, right? Or these 2 places. But the correct answer is tax advantage. And I try to give you guys a tip because it was already circled. Circling it again. So tax advantage. But let's start from here. So tax now, right? So what does this mean? This means any type of income, rental income, your normal income, any type of money. If you're making more money, what's gonna happen? You're gonna pay more in taxes, right? So when it comes to putting money away, this is showing the stock market. So a lot of people like to put money in the stock market because of liquidity. And I agree, if you understand how to invest in the stock market, go for it, right? And there's also the banks. Mutual funds, CDs, depending on the bank, sometimes they'll pay you little to no interest rate, but it's good for what we call liquidity, okay? So that's why you would want to put money in here. Now, when it comes to taxes let's imagine you have $100 in Apple stock. These $100 grow to $300, okay? So what ends up happening is you decide to access that money. You gotta pay capital gains tax on the growth of $200, right? It's been around 15%. Why? Because they want people to invest. So the government gives you a low tax bracket. And it varies depending short-term, long-term, but what I've seen is around 15%. But what you have to understand is you already pay taxes on this money, right? Because it already got it taxed. From there is you're paying taxes again on capital gains. And sometimes you end up paying at the end of the year when you do your taxes, okay? So sometimes you end up paying taxes around 3 times. Now, what I advise and what any other individual I would advise concerning putting money here is you want to put around 3 to 6 months of income, okay? That's what you need to put here. When it comes to the tax deferred, right? The tax deferred is most of our retirement accounts. The government and society has told us that these are the only type of accounts that we can use, right? And what there are is the 401k, the 403b, the 457, the IRA, the SEP-IRA, TSPs, annuities. So all of these have different names or even different codes, right? And those different codes is to make the job of the IRS simple, right? They want to differentiate someone that works from a company, like a 401k, to someone that works with a school, like a 403b, or someone that works for the Navy or the Army, a TSP. So it's all the same. It's an investment account for the future. And what deferred means is that you're gonna pay taxes on the future. Now, the scary part about that is that is up to the government. Up to government to know at what tax rate you're gonna be at. So there's 2 rules that we need to understand, okay, concerning these plans. The first rule is 59.5 penalty rule. So if you pull out money earlier, right, at 50, you're gonna get penalized 10% plus taxes. That's what's gonna happen, 10% plus taxes. Now what we gotta think about is, let's imagine you have $200,000 and you pull out the money at 50. You're gonna end up paying 30% from taxes or even more, plus the 10%. So 40% of your money, that's a lot of money in taxes, okay? Now there's the other individual that I've seen that they say, you know what, I don't wanna touch that money. Those 300,000, 400,000, whatever it is, I don't need it, Isaac. So I'm not even worrying about it. Well, if you're listening, there's another rule that we need to be able to consider, and that is we call it 70.5 rule, or RMD, required minimum distribution. So by 70.5, you need to start pulling out money. And it all depends on the state, your age, everything, right? There's different calculators where you're gonna know exactly what's your required minimum distribution, also on the amount that you have. But you need to start pulling out by 70.5. Why? Because the government wants to tax you, okay? That's all it is. So if you don't pull out money by 70.5, you're gonna have a penalty of 50%. And we're not including taxes. And then let's say taxes are at 30%, right? So you're gonna end up paying around 80% in taxes. And this is not good. It's not good up here either. So let's imagine John, Jane, Stephen, whatever your name is, you decide to pull out money exactly at the right moment. Okay, you decide to pull out money at 67 years old. And you've accumulated $500,000. If you're listening to this video, it's because you already saw the video where I was talking about taxes and why they are, it's bound for them to at least double. So let's imagine that they don't double. Let's imagine that they don't go all the way up to 70, 74%. Let's imagine they go up to 50%, okay? What's 50% of $500,000? You would pay $250K in taxes. That's a lot of money, okay? Now, what's the good thing? Because these things, like anything, anywhere where you invest, there's always gonna be the pros and the cons, and that's something you need to understand. The pros for this is if you're getting matched. All these different type of companies, they match you. So you wanna put in, if they matching you at 3%, that's all you wanna put in there. A lot of people, they put in way more money, not knowing that they're gonna get taxed in the future. And that's something you need to think about, okay? So we need to always be focusing on taxes. Third thing is the tax advantages. The first account is a Roth IRA, right? So if you have a Roth IRA, it's a really good account, but there's limitations. For 2019, because this changes every year, what you can put in here is up to $6,000. That's the maximum, right? If you're single, the maximum, if you earn more than $122,000, that's where you can't fund the Roth IRA anymore. And I think if you're married, I think it's 193. Again, guys, these things have shifted from 2018 to 2019, but that's what I found on the internet. So this is if you're single, and this is if you're married. If you make more money than 122 single, you can't fund a Roth IRA. And if you make more than 193 combined income, you and your wife, you can't fund a Roth IRA. So what happens there is that you don't get that benefit. You gotta be able to go out here and maybe fund an IRA. So the beauty of the Roth IRA is that the money, it's already taxed, but when you pull it out, it's tax-free, okay? Another account that offers money tax-free is what we call the LIRP. It's Life Insurance Retirement Program. There's all these different type of products that you can utilize. There's what we call the whole life. There's what we call the IUL. There's what we call universal life. So there's all, and we can keep going on. There's a couple more, but those are the most popular ones. So the good thing of the LERP is the government, anything that they see that it's a benefit for the people, they'll try to incentivize, okay? So when solar panels became popular, right? The government would give you, I think, like $20,000 back from whatever it cost you. So they would give you a good benefit to be able to put solar panels. Also, when it comes to these type of accounts, they want you to save and prepare for the future, right? They don't want you to touch this money until you get to retirement. So they're trying to give you a benefit, right? On not charging you taxes or giving you a tax deferred strategy, okay? So there's all these different type of benefits that the government tries to give you, and they see something good. In this situation, they see something good in you being protected and protecting your family. So that's when they give you the benefit. And a lot of these products, the money that it accumulates, once you touch it, it's tax-free, okay? So I'm gonna break more of this product in the next part of this video. Thank you and have a good day. So guys, hopefully you enjoyed that video. Please guys, if there's any type of questions, my information is below. Feel free to contact me. I'm always happy to hear about you guys, and comment below, like and subscribe. Take care.